Hello, and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, as China heads into its Golden Week holiday, there won't be much celebrating in the real estate sector. Chinese property stocks are trading near the lowest levels since 2011, and concerns are growing about more defaults among developers. How did the housing market in the world's second largest economy get so out of whack? And what will it take to fix it and help Chinese stocks catch a bid again? We'll get into it with a fund manager who focuses on China and emerging markets. But first, a programming note. Well, we've been going strong for 4.5 years, but What Goes Up will be going on hiatus after this episode as the Bloomberg podcast team works on some exciting new shows. So keep an ear out for them. And as always, tweet to us at the handle @podcasts on X to let us know what you think of the shows. Valdana, is it still tweeting now that the thing's called X?
Does anybody even call it X?
Elon does.
Elon? But who else? I never say, let me check my X app.
But do you X a post?
X a post?
Yeah.
Huh. I haven't heard
I thought you would
anybody...
have the answers. I thought you'd have the answers.
I'm not a hip millennial. But our guest this week, he might be active on X/Twitter. I'm not sure. But he's definitely been on the podcast before, and I'm happy to welcome him back. It's Jason Su, Chief Investment Officer at Rayliant Global Advisors. Jason, thank you so much for joining us.
Super glad to be back.
I wanted to start out with asking you to tell us a bit about yourself because you have a very interesting background, having worked with Rob Arnott in the past. And you guys have, as Mike said, we're going to be focusing on internationally in this episode. So you guys have a presence in a lot of places around the globe. So tell us a bit about yourself.
Well, as you mentioned, I started a research affiliate with Rob Arnott. That's nearly 20 years ago now. I spun out in 2016 to focus primarily on emerging markets. And of course, when you think about emerging markets, you can't ignore China. So a lot of my research, a lot of, our quant models are built to create alpha in China. Today we got ETFs in the US that gives you exposure to China, to EMX China, and actually more broadly, the global markets. Basically, that just tells you the power of the quantitative methods when it comes to alpha generation across the globe. Today I am talking to everyone from Dubai, and that's because the Middle East has a almost opposite of the US, has a meaningful fascination, and it's probably from a strategic allocation perspective very overweight China. So that's why I'm out here.
That might be our first guest tuning in from Dubai. That's a first for us, Valdana. That's pretty cool.
I've never been over there, so I was asking Jason before we started taping, what's it like? And he said it's very humid, which I didn't expect.
But Jason, let's get into this whole problems with the property real estate sector in China. I mean, my sort of layman's understanding of it is that China's developers just built entirely way too many apartments than what's really needed. How did that happen? And how bad is it, do you think, the debt problems of the developers who are having trouble selling all these apartments?
Yeah. So when you think about kind of apartments in China, right? If we think about it from kind of the US perspective, which is, well, you buy it to either live in it or you rent it out to collect the yield, then you're absolutely right that there is a overbuilding of apartments in China because there are lots and lots of apartments that are owned but not lived in and not rented. So it's very unproductive. But if you're a Chinese, and I'll give you kind of a funny anecdote. So I bought a few apartments in China very early on. So they're quite cheap at the time. And I go, they're kind of empty. So let me rent it out. When people realize that, they kind of look at me funny and go, Jason, are you in financial trouble? Why would you rent out your place to someone else for money? So Chinese don't think of apartment as like a fixed income, right? That produces a income for you. They think of it more like, I would say, how Indians think of gold, right? So it's more of a store of value. So they're perfectly happy holding an apartment, leaving it empty, believing it holds value. Does it always go up? Frankly, doesn't enter into their psyche. Now, it's been lucky that's been going up, but they really see it as a store of value, right? Just something that's solid, they can look at, they can point to, and oftentimes they brag about it. From that perspective, there's enormous demand when it comes to the Chinese appetite to buy property. And that demand is purely almost like collecting, right? It is not for consumption and it is not for investing. So I think that's just sort of useful to understand that. And I guess, your question about, well, are the developers in trouble because maybe the Chinese are cooling off on their preference to hold, wealth in real estate? I'd say the Chinese developers are mostly in trouble, not because somehow Chinese investors have I think what's more an issue is a lot of them have simply geared up way too high. Your Country Garden, your China Evergrande that went under last year, they simply borrowed way too much debt, and they were hoarding land and hoarding apartments and not selling them fast enough to pay down the debt. They're just borrowing more to hoard more land, and I think they just irritated Beijing a little too much. And I would say these are not a real estate related triggering a bankruptcy, but almost a policy engineered bankruptcy targeted at real estate developers that have simply become too geared, too levered up.
Yeah, I wanted to ask you about that because there's always sort of this assumption in the West that Beijing can come to the rescue anytime it wants for a problem like this. I don't know how true that is, but in this case, they have done some things on the margin to try to shore up the housing market. That eased some of the mortgage restrictions. They're lowering the reserve requirements for the banks. Is that all they can do? I mean, to your point, are they actually really holding off on sort of a big bazooka fix for this because they do want to wring some of that excess leverage out of the market? How do you view the policy response to this and what the goals of it are?
Yeah, I would say, in fact, I think the government doesn't think right now there is a meaningful problem in the real estate sector, other than, consumers seem to be disappointed about how real estate is performing, and therefore that lack of confidence may be causing them to not consume. So the government realized, the most reliable channel for wealth effect, which is basically real estate appreciating, that has caused households to be willing to increase consumption, that channel has temporarily gone away. So, they recognize that. But of course, the bigger problem they're trying to contain originally was they didn't want real estate prices to get more expensive. Because it wasn't it wasn't becoming a financial problem, it was becoming a social problem, right? Homes were too expensive for young people to buy. But from a financial problem perspective, if you look at the household sector, right? Chinese households are not levered when it comes to real estate. Developers are very levered, but the household, which is far more important, right? They're not levered because they can buy their first home with money down, and they pay quite a bit of money down, and they generally have to sort of have enough income to cover the payment. If they want to buy a second house, it's got to be all cash, right? So most Chinese, and if you live next to a Chinese in your neighborhood, you realize they buy real estate all cash. And that's how they buy real estate in China as well. So you don't run into a financial problem when you buy real estate all cash. It might be a bad investment, right? You might buy something and never goes up, right? It has no yield if you don't rent it. So it might not be a great investment, but it doesn't become a financial crisis. So I think the government's okay with where real estate is today, right? Prices isn't going up. The bankruptcy you're seeing in the developer sector is very engineered. On the household side, there's not a balance sheet crisis because they're not buying real estate on leverage. So they really don't think there's a meaningful problem there. Now, of course, they wish the Chinese household would have found like another store of value or another asset that's more productive that the government could sort of help manage and create a wealth effect. Now, they're hoping the stock market can be that, but remains to be seen if they can get all of that money, that unproductive money in real estate, into the more productive long-term investment in the stock market.
So say more about the consumer and the state of the Chinese consumer. Is that another facet that's under pressure right now in China?
I think that is the biggest problem, right? The consumers, China and I guess Beijing specifically, has been hoping that China wouldn't just be an export-oriented economy where everyone just works so really hard in the factory and ship everything overseas and then never spend money, right? And that's been a bit of a sort of a traditional Chinese mentality when it comes to working excessively, saving excessively, and not consuming enough. So it's too dependent on export. So gradually, domestic consumption has actually picked up quite a bit. We're seeing GDP going from 36% export to today only about 16% export. So consumption has sort of picked up. But more recently, consumption gone fairly flat. And part of that was COVID, right? I mean, when Americans came out of COVID, we go, yes, we saved up money. We haven't been spending money, so let's go spend money, right? There's this revenge spending. When Chinese got out of COVID, they go, my God, that was horrible. So let's save more money so we can self-insure, right? It was a complete different mentality, right? So, Chinese, after any major crisis and disaster, they just go and save more money. So part of it was that. And of course, part of it was, I think, disappointment with how Beijing has both managed, the COVID lockdown and opening up, and also disappointment with how poorly GDP has performed post-COVID. So again, both of those has caused, I think, consumer to go into a wait and see mode. So you're not seeing people spending money. It's not because they don't have money, right? It's about $30 trillion, not even renminbi, but dollars equivalent of household savings in bank accounts and sort of quasi bank accounts, money markets, trust products, but they're just not spending money. It's a confidence issue.
30 trillion.
Yeah.
Wow.
They save a lot of money.
You launched the Rayliant Quantamental China ETF. I guess it was at the end of 2020. And it's been a bit of a rocky launch. It's down about 42% from the launch. Talk to us a little bit about the strategy, how you pick stocks for that ETF, and why this early couple years of it have been so rough.
Yeah. So, the beta has been a major, major headwind. I think we launched a product at the time where we believe, as China gets incorporated more into the sort of MSCI basket, there's going to be sort of natural flow going into the asset class, and people are going to start to get more curious about, can you directly invest in China rather than just buying Alibaba as an American ADR? Maybe let's look at the next Alibaba, right? An unknown firm listed onshore. So, we launched an onshore product that focused on A shares, and of course, we ran headlong into essentially 3 years of turbulence, all the way from the COVID lockdown to really government, experimenting with policies of, how to manage e-commerce platform companies. And I would say Xi Jinping, as he's marching into his third term, there's just a lot of uncertainty with regard to what will that look like, right? Will Beijing, after power consolidation, still kind of pursue the same kind of pro-growth policy from the previous eras, or would there be a major shift, right? So there's just a lot of uncertainty, and I think sort of early signs has not really, caused people to develop confidence. And certainly you got the China-U.S. Tension that started with, President Trump and continued through President Biden. So we ran into a lot of sort of beta headwinds, unexpected, of course, but it is, I would say, par for the course when it comes to investing in emerging markets. This is China now. If it's not China, I'm sure there are many, many other emerging countries that also run into such geopolitical tensions, with someone, be it with China, be it with the U.S., and also their own domestic election cycle can play in heavily into sort of the beta headwind as well. But I would say par for the course for EM investing.
So can you talk about how you're making sense of what else is happening in the emerging markets space? Because emerging market stocks gave up their gains for the year. So any gains that we had up until, I think it was a couple of days ago, actually, they gave up all of those gains. I'm wondering what the biggest pain point for emerging market stocks has been this year. Is it what's going on in the U.S. in terms of rising interest rates? Is it China? Is it, multiple of those factors weighing on EM stocks? How are you making sense of what's going on?
Yeah, so you basically have the perfect storm. Our quantitative process looks all the way from kind of the micro bottoms up and taking into account kind of all the macro data. And unfortunately, you got everything going against you, right? Kind of on a fundamental side, right? EM is still so dependent on DM consumption, right? So when EM is performing poorly, oftentimes it's because EM is looking to DM to drive consumption growth so they can export, right? EM is very much a raw resource exporting, manufactured good exporting. So Europe has clearly been weak, and most of the manufacturer in EM has been sort of forecasting a U.S. hard landing, so they weren't aggressively seeking to build capacity, and so you got that going against EM, and then of course you have the dollar at record high yield, and so EM have historically depended on a lot of global capital, and now you have this global capital fly away from EM back to the dollar because dollars safety and yield is just so much more attractive. So it's pulling capital away from some of the capital poor economies. So that's a major headwind as well. So you kind of got a fundamental against you. Now you got kind of the financing, the liquidity part against you. And from a sentiment perspective, EM sentiment is more fragile, right? Local stock markets are shallow. So when our quant scores look at sort of sentiment scores, what we've seen is sort of, as poor of a sentiment score across the board for EM, not just for China, but really across the board for EM, and not just domestic flows, but even, more long-term institutional global flows are showing very poor sentiment.
Where do you see opportunities in EM right now then? How are you thinking about the broader landscape?
So I would say, short-term versus long-term. Short-term, I would say the interesting and fun plays are really all the friendshoring themes. And then, those could last all the way from a few months, perhaps maybe, a year or two. So, you have, Mexico now being, I think, front and center for a lot of people thinking, hey, friendshoring Mexico is an obvious candidate as an EM economy that's big enough and obviously close enough to the US for that theme to really sort of drive investment into Mexico. India, obviously, Vietnam, being where a lot of Chinese entrepreneurs and factories have moved production to. And so that friendshoring exercise has sort of pushed a lot of foreign direct investments from China, and from Chinese into Vietnam. So I would say there are a lot of opportunities around the friendshoring concept. That's kind of in the short term. And we saw that major rally for India before it pulled back more recently as well. But in the long run, I would say in the long run, where I think the opportunities are, it'll continue to be the export-oriented and high-value-add economies. Your China, your India, and increasingly so your Vietnam, your Indonesia as more foreign direct investments, leave China to go to these smaller economies. They're going to follow kind of the Japan, South Korea, Taiwan, and of course the China model of exporting, and then through exporting, improving corporate profits, improving GDP growth. And I'm probably a bit more mixed about purely resource-based EM economy because they seem to go through these boom-bust cycles that are just driven by commodities prices. And if commodities prices could sustain the current high level due to geopolitical tension, but without really strong value add, I'm a little, less fond of a pure resource-oriented EM economy. So very fond of the Asian EM because you can see all of them are climbing the productivity curve, and the friendshoring is certainly going to accelerate the process.
I like that expression, friendshoring. It's a lot more friendly expression than the rest of the world is at each other's throats. Friendshoring is the positive side of that, I guess. But Jason, I'm glad you brought up the dollar because one of the things I wanted to ask you about is the really severe weakness in the Chinese currency lately. It's even been sort of testing that 2% trading band that the People's Bank of China sets every day. I mean, is there a risk of the PBOC sort of losing control of the exchange rate, or do they always have enough sort of firepower to keep it in that, range that they want it in?
Yeah, so I would say the PBOC is pretty mixed when it comes to managing the renminbi. Part of the PBOC clearly understands that it is still an export-oriented economy, and for stimulating the export sector, which is really great for domestic employment and obviously key cities that have thrived because of manufacturing, like a weaker renminbi helps, right? And so it understands that. Now, of course, it doesn't like to be labeled as a currency manipulator. It doesn't want sanction that comes with that. So this is sort of perfect time as the dollar increased rates and have strengthened, for renminbi to weaken. It's certainly weakening at the perfect time when China is experiencing sort of deflation, right? And so I don't think the PBOC minds it. Now, of course, the PBOC is sort of constantly watching to see if intervention is necessary. Again, I mean, from an intervention perspective, given that first of all, China has a sort of massive dollar reserve and other currency reserve, and given that increasingly China has been successful in marketing renminbi as a viable reserve, certainly for clearing for some of the energy related resource, renminbi in the position it is in right now doesn't really have an issue, much like the LATAM currency when they're trying to defend a peg, right? You just don't have that issue because of the reserve they have and also the reserve status that renminbi is increasingly achieving.
Jason, I'm curious how you think investors are thinking about EM opportunities right now, because we've had, barring the last couple of weeks maybe, we've had really strong performances from U.S. large cap tech companies so far this year. And so I'm just wondering how you think people in general are thinking about investing in EM versus investing in large cap U.S. tech companies, or even to make it maybe more relevant to the last couple of weeks, investing in shorter dated bonds or cash-like instruments where you can maybe get, north of 5%. Some of the yields are like 5.5% currently.
I mean, historically, people bought EM because they say, hey, I'm happy to take some risk if this allows me to buy kind of the foundational components for growth. Like you look at EM, you go, yes, a young, hungry workforce, and that's got to drive growth, right? Hey, it's an inefficient market. So, that's got to provide lots of opportunity for growth because, capital is dearth in those markets. So if you can go supply capital, you can return, a fantastic return. But I would say more recently, you kind of have, those thesis going against you a little bit in that people are now looking at U.S. and say, well, if the U.S. is going to be at, ground zero of the AI innovation, right? I mean, maybe that's where I go buy growth, right? Maybe growth is not about, buying, young, lesser skilled labor cheap, but it might be buying AI technology that'll replace, that labor. Now, I think that thesis is wrong because, most of our AI is replacing American white collar worker rather than factory workers, right? Because we don't actually have very functioning robots, right? We just have ChatGPT that can write law briefs. That's not what we're getting the Chinese factory workers to. But be as it may, I think there's just a lot of now believe that, if I want to buy growth, maybe I should just dump a lot of money into NVIDIA, right? And I'll buy growth that way. I don't need to take the risk of EM. And certainly, historically, there's a lot on the fixed income side, right? You also have a lot of people going to EM fixed income for the higher yield, knowing that they're taking currency risk, they're taking a lot of these government mismanagement risk. But today, you look at how much the dollar's yielding at, it's harder to make that case. So you kind of got a bit of double whammy against EM right now. The two key theses, growth and that additional yield. U.S. seems to be making that available through the large cap tech and just the dollar treasury yielding at 5.5%. So rather tough as a headwind for EM in the short run, right? In the short run, I mean, we fully expect, the U.S. interest rate is going to get cut because we owe, $34 trillion. So we prefer to owe $34 trillion at zero interest rate than 6%. So you imagine that's going to get cut and the attractiveness of the EM currency and yield is going to come back. You also expect that we'll quickly realize that, there's tech growth, but then there's a lot of manufacturing that's needed to produce that tech. So EM is still going to be an important driver. So in the long run, I think those theses are true. But short run, past performance tends to draw a lot of flow. So U.S. has had the best performance.
Jason, I know you've done some work looking at whether it would make sense to sort of carve China out of the emerging market stock indexes, as China decoupling from the U.S. and maybe even the other emerging markets. Talk to us a little bit about your thinking around that. Are we going to hear more and more about sort of EM ex-China type of funds? What's your take on, the notion of EM indexes that exclude China?
Mike, when I originally did the research, my rationale for Xing out China was more about, China is so big inside EM, right? So if you don't X out China, then China has a bad year, EM has a bad year. So you're not getting a lot of diversification benefit, right? You take out China's not very correlated with the rest of EM, so you got more flexibility. Correlation benefit is better, and then it just seems to make sense. It's like how we took U.S. out of global equity, so people did U.S. and global ex-U.S. Right? That parallel makes sense.
China's what, close to half of the MSCI EM index, something like that.
When before it declined 40%, it was about 50%. And so, that I thought was like a very academically defensible reason, but no one paid attention to that. But today, people are liking that concept because they sort of have a sort of bad taste in their mouths. It's like, China's fallen too much. If I had taken China out of my EM would have done better, right? So there's a little exposed regret, and there's also, I think, a lot of value judgments. And again, I'm perfectly happy where people both invest and impose some kind of ESG value judgment in their portfolio. So it makes sense, right? Like take China out, it gives you that flexibility, right? You can be You can be an ESG investor and say, well, China doesn't, the fact that the government is communist, so that's not consistent with my value. Okay, that's fine. You could be like a contrarian investor and say, wow, everyone hates China, so I'm going to buy China, and that could work as well. So you take China out of EM, it allows people to sort of asset allocate, whether because they really like China or they really hate China, and they don't just have to do it within the context of one big EM basket.
Jason, I can't even imagine all of the things you have to be keeping up with in the world to be able to formulate some of these thoughts. Like, I'm thinking about some of the elections that are coming up in major EM countries, lots of stuff happening in Argentina, etc. I'm wondering how you're thinking about the remainder of this year and whether or not you see more volatility or if there are some opportunities to be buying, different EM stocks.
Well, so we really like EM. Again, the short term is hard to predict. And my guess is for the rest of the year, sentiment will remain negative. The volatility will be there. But most of our clients are large institutions. So at least I can tell you, for institutions to build a position to, dollar cost averaging into a position is a great way to invest for the long run. And from a valuation perspective, EM is cheap. You can't expect to go into EM and immediately see it sort of turn around and start, recovering. But you can probably bet on in 10 years, if you buy at such a cheap level, if you're willing to sort of ignore short-term fluctuation, you're going to do plenty well. Right? And like I said earlier in the program, like the world's always like the twin engine, right? Like kind of US as the head of DM, really innovating. So it's driving growth through innovation, and EM is achieving growth through imitation, right? So you got innovation and imitation. Those are two amazing engines that keep the world going, and then you should, have both.
Right. Jason, you touched briefly on the trade tensions between the U.S. and China. I'm wondering how you're thinking about that going forward. I mean, what is sort of the status there? It seems to me like kind of a stalemate, a standoff, but is there a path towards reconciliation? Where does this relationship go?
I'd say, yeah, there's a lot of, bickering back and forth. I tend to see the U.S.-China relationship as a abusive, codependent marriage, right? Like, if you think about it, right? Like, the U.S. is the world's biggest consumer, right? And we run a massive trade deficit. And that just means someone must be a big producer, right? We can't all be consuming, right? Someone's got to make stuff. And we can't all be borrowing. Someone's got to lend, right? Like US consumes and we borrow from foreign countries. And China needs to be that willing partner to produce and lend us money to consume. So we can't break away from each other, right? And then we're both too big, right? It's not like US can go replace China with Vietnam and say, hey, we'll give you the Chinese deal, right? Where you do all of our manufacturing and lend money to us. Because Vietnam's got a population of 60 million, right? China's got, 1.3 billion people. So just the math of the two economies being so large, and they almost are like the perfect fit for each other.
Well, Jason Su, he is the chairman and chief investment officer at Rayliant Global Advisors. Always great to catch up with you, Jason, and hear how you're thinking about the world. You've got such a great way of explaining everything. And as Vildana said, you've got your eye all over the world, which we really appreciate. But we can't let you go quite yet. We do have a tradition on the podcast of sharing the craziest things we've seen in markets this week. Vildana, let's start with you.
I have a good one that I found on X. Mine is about Taylor Swift and Travis Kelce.
Okay.
Yeah, I know you prefer a separate Swift-Kelce pairing on the Eagles, probably.
That's right.
This one's more important to the world of pop culture and Swifties like me. But just to show you the Taylor Swift effect, this is a tweet from Joe Pompliano. Taylor, as the entire world knows now, was at the Kansas City Chiefs game over the weekend. She was in a box with Travis Kelce's mom and a bunch of friends, and they were having a really great time. X/Twitter went wild, and people everywhere went wild for this. Anyway, after, Taylor Swift visited him at this game, he gained more than 300,000 social media followers.
Wow.
They saw a 400% increase in merchandise sales, and his jersey became one of the top 5 selling jerseys in the NFL. The NFL changed their Twitter X, well, I can't say X, honestly. their X description to say, like, Taylor Swift was here. Like, it just, the impact was mind-blowing to me.
My wife has a conspiracy theory that ratings were going down for the NFL games, and they needed to bring in an influencer.
I've heard this conspiracy theory before. I don't buy into it, but
I like it. That's a good, as far as conspiracy theories go, that's a good one.
400% increase in merchandise sales. That's huge.
That's your market angle, I guess.
Yeah, exactly.
I need to hire Taylor Swift to sell my ETF.
You got to make a friendship bracelet with the ticker symbol on it, Jason.
Yep.
That's what Kelsey did. He made a friendship bracelet with her number. Who would have thought that would work? Well, how about you, Jason? You see anything crazy in the last week or so?
I mean, it's a long-running theme for me, and because I have such a grudge against NVIDIA, I saw this on X. But it may have been on there for a while now because I'm in the Middle East. I'm a little out of touch, right? Someone actually said, like, NVIDIA may be a bit of a Ponzi scheme because apparently they bought a company who's like the biggest buyer of their chips. And like, if you work out the accounting, all of their sales growth was driven by, this other company. So there may be some funky, weird thing going on. But in full disclosure, my big grudge against NVIDIA is not because I got a short position in it and got my clock clean. None of that. It's because my mom bought NVIDIA at $100 a share. It went up to $250 on that crazy upgrade. And I said, Mom, this makes no sense. You should sell it, right? It reminds me of Cisco during the tech bubble where everyone says, oh, of course, everyone would need to buy a router and, Cisco will own the world. And so, that's kind of the same narrative I hear about NVIDIA. So I told my mom, sell NVIDIA. You make such a good gain. And of course, then it goes to like 450. So every time my mom sees me, right, she's like, I have an idiot for a son. So until NVIDIA falls below 250, I'm going to be like putting a hex curse on that stock.
That's hilarious. Well, that's kind of, I think, very indicative of the mania that takes over that just doesn't seem to make sense. Now, granted, NVIDIA's got a very good bull case, but, when your mom's outperforming you, something's out of whack with markets. I love that story. That's hilarious. All right, well, I'll give you mine. Vildana, do you know what the highest denomination Federal Reserve bill is? In other words, the highest denomination currency, paper currency, is right now?
$100? Did
you know during the Great Depression, and prior to that, I assume too, there were bills denominated in 10,000. There were $10,000 banknotes available. They never circulated publicly. They were basically just used to transfer funds between various Federal Reserve banks. But this is according to a story in the New York Post. One of them that was printed in 1934 just came up for auction. And the picture on it is President Abe Lincoln's Treasury Secretary, Salmon P. Chase.
Wow.
The question for you two game show contestants right now is, what do you think this $10,000 bill from 1934, pristine condition, sold for at the Long Beach Currency Expo?
You can't use it, right?
That's a darn good question.
You would just have it like to hang on your wall.
That's a very good question. I assume I'd have to zoom in on the picture and see if it says legal tender for all debts, blah, blah, blah.
Mm-hmm.
That's a good question. I don't know. I will tell you this. For what it sold for, you would not want to spend it. That's one hint to the value that it sold for.
I'm going to guess it's below 2.3 million, which is, I think, what the Tom Brady baseball card fetched. So it can't be more valuable than that. I'm put a crazy number out there. $500,000.
$500,000. All right, Vildana, what's your bid for a $10,000 Salmon P. Chase bill from 1934?
I literally have no guess at all. So I'm just going to go with 10,000.
$10,000. You think it's just sold for par?
Yeah. I'm just going with that. Yeah.
All right, Jason. It's a shame your mom's not here because you just got some redemption here. You're very close. $480,000
Wow.
for the $10,000 bill. Yeah.
Wow.
Apparently, this is a huge collector's market. Is old bills of high denominations like this. Who knew? You learn something new every
Usually
week,
I have like at least a little bit of like a feeling toward what something might be, like, even if I'm wildly off. But on this one, I had absolutely nothing. I just would not even know. Your hint didn't help at all. For what it sold for, you wouldn't want to spend it.
Yeah.
Because there's no NFT auctions now, so people need something to collect.
Yeah. All right, Jason Su of Rayliant Global Advisors. Thank you so much for your time.
Thanks, Mike. Thanks, Madonna.
Thank you, Jason.
Well, thank you for listening to What Goes Up. While we're on hiatus, you can follow or subscribe to What Goes Up to stay tuned for updates. We'll be dropping information about what's next here in this feed. You can also follow Bloomberg Podcasts at Podcast on X. What Goes Up is produced by Stacey Wang. Our head of podcasts is Sage Bauman. Thanks for listening.